Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called Grant Williams, the Big Macro Divides and De-dollarization. Just a reminder, the information in this podcast is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to nucleuswealth.com/contact and you can book a call with me to have a no obligation chat. Today's episode is a pre-record because of the time difference with Grant, so we'll not be able to answer any questions in the live chat today. Today, as always, we have Damien Klassen, Nucleus Wealth's co-founder and chief investment officer. Damo, welcome.
Hi, Sam.
G'day. Today, I'd also like to welcome a special guest, Grant Williams, who's a titan of the financial podcasting world. He runs a number of different podcasts and writes a newsletter called Things That Make You Go, Grant interviews the biggest names in the industry and examines the core macro arguments of the day. So it's an absolute pleasure to welcome Grant Williams. Grant, welcome.
G'day, fellas. How are you? It's an overly generous intro, I've got to say, Sam. Thank you. Titan, I'm not sure Titan works very well, but hey, let's go with it for the sake of the next hour.
Well, we're stoked to have you here.
Yeah, that's right. And you know, I guess from my perspective, you know, a lot of what you write about is sort of the idea about the end game. Where are we going with this thing? There's always this, you know, the short-term fluctuations in the market. Everyone's right. Stop clocks are always right for a couple of minutes each day. And the question is, you know, where are we going and how are you positioning your portfolios for it? And that's something you dive into, you know, every week with different guests. And I guess what I really wanted to get out of you is some of the thoughts about what, you know, where you think this is going, and sort of by posing some of the bigger questions, I guess we've got for the markets right now, and sort of picking your brain on it. So I understand that you do a lot and you write a lot, so it's probably going to be a less deep dive than what you do into these topics. But you know, if anyone's, I guess most of these you would have done something on, and if people want, they can go to grantwilliams.com, I guess, and get more info.
Absolutely, yeah. There's never nothing to talk about. That's for sure. So we can talk about whatever you want. I guarantee we'll find something interesting to pick apart.
Yeah, well, let's start with the one we've got going on. Some of the big thoughts. I've got a whole bunch of them, but you know, we'll start with probably the biggest one is the recession versus soft landing argument that's out there. And you know, there's obviously lots of people on both sides. We've had a bit of an introduction from AI, I guess, into the last few weeks into, you know, one more reason there could be a soft landing. And it looks like we've got feds and central banks that look like pretty determined to keep raising rates until we do get to a recession. So I guess I'd head over to you, and you know, which side of the divide you land on for economic sort of pushes.
Well, I think for me the important thing is really this whole idea of having to land on a side. I think is the place where everybody gets themselves into trouble, because you know, we live in a world that becomes increasingly dogmatic, and also pretty much everything everybody thinks now, they think out loud in front of thousands of people on Twitter or social media or whatever. And that makes it very difficult for a lot of people to change their mind, because they become wedded to a view and they become well known for having that view. And so it's tough to back down in front of an awful lot of people that know you as the recession guy or the soft landing guy, you know? And so I'm always amazed that people will pick a side of that argument, convince themselves that that's absolutely the way it's going to be, will defend that hill against all comers, tell everybody else why they're idiots and how could you possibly think anything else, and then sit and wait to be ultimately proven right. So, you know, for me, it's funny, you mentioned the podcast, The Endgame, and one of our earliest guests, a guy called Mike Green, who's a very dear friend of mine and a super smart guy. His first words, I think, on the third episode of the podcast were, well, of course there isn't an end game. And he's absolutely right. You know, there isn't. What I think we're all trying to figure out is, how do we transition from here to whatever comes next? I mean, Bill Fleckenstein and I called that the end game, i.e. the end of this particular financial system. And what does the next one look like? So I think that's kind of what we're all trying to figure out. A recession will play a part in it, for sure, because that is going to hasten policy responses that will be designed to avoid as much pain as possible. But of course, those policy choices are coming up are going to be coming at a time where they've exhausted all the kind of free money, laissez-faire, quantitative easing policies that have helped us accelerate the motion towards the point we're at now. So for me personally, I struggle to see how a soft landing is possible. You can't rule it out. You'd be foolish to rule it out because we just don't know. But I put the lowest probability on a soft landing. The question is, will it be a hard landing or a muddle through or a mild recession? That's kind of where my head's at. I think there are ways it could be a very bad recession, and there are ways in which it could be a more mild recession. But unfortunately, the data at the moment are confusing an awful lot of people because they're just not playing ball. And so you've got this weird situation where for a decade and a half, central banks around the world have been using this fabled forward guidance. You know, forward guidance is a key tool in our arsenal, and we are going to talk about what we're going to do to smooth the future out, make sure no one gets caught offside. The markets can be smooth. The markets can be well warned about any policy changes, and that worked really, really well when all the forward guidance was about how great the future was going to be and how long interest rates were going to be at zero and how long you could borrow money for nothing and how long there was going to be abundant liquidity. That forward guidance worked really, really well. Now we're in this bizarre situation where everybody has trusted the Fed and come to believe everything they say about the fact that, hey, money's going to remain cheap forever. And your beloved RBA governor, Phil Lowe, obviously is probably front and center when we get into this next part of the debate.
Yeah, absolutely.
But, you know, we're not going to raise rates until 2024. You can go out and borrow and not have to worry about interest rates going up. Now we've reached a part where they are trying to use forward guidance in the other direction and say, look, inflation is going to be here for longer. We're going to have to raise rates. We're going to be higher for longer. And you have to understand that. And of course, the markets don't want to believe that because it's not in their interest to believe it. They want the markets to go up. They want asset prices to keep rising. They're convinced that the central banks will blink at the first sign of trouble, which is exactly what they've been conditioned to do by, you know, some people push this back to Greenspan in '87. So if you want, you can go back best part of 40 years in this policy. So it's no real surprise that people have become conditioned to think that way. And yet, Phil Lowe apologizes, which is unheard of for a central banker to do, about having to raise rates. He then goes and raises rates, in 10, 25 basis point hikes so far.
Yep.
And then he stopped. And everyone said, right, that's it, we're done. And now he's come out again because inflation's sticky. Bank of Canada, similar situation. These surprise rate hikes, which shouldn't be a surprise to anybody. So we're in the kind of the worst part of this, because we're now in the point where all the cross currents are meeting, and you've got inflationary pressures, you've got recessionary pressures, you've got central banks who promised to do one thing and are being forced to do another. You've got all this uncertainty, and markets are continuing to climb this wall of worry, led by kind of tech and AI stocks in the US particularly. But that uncertainty is increasing every day. And when you don't have a voice like central banks in the middle of all this, standing behind a podium, looking very official and very calm and telling you what's going to happen, when you have those people not making much sense or wavering, or worst of all, going back on what they've promised, it just ups the uncertainty. So for me, I feel like some kind of recession is coming. I would skew towards harder rather than softer. I just don't know when, and that's really the problem. The question we're all faced with is, okay, if a recession's coming and that's our base case, how do we prepare for it? But if you prepare for it too soon, you give up some material returns, and being early is being wrong. So this is where we are. We're in a really tricky spot now, and everybody needs to think through the ramifications of, if this recession arrives, and Aussie's probably more than most because it's been such a long time since you've had one. If a recession arrives, what does my current portfolio look like under those circumstances? And I would bet dollars to donuts that most portfolios are absolutely not set up to avoid a recession, because how could they be? Because we just haven't had that as a problem to face for a long time.
Yeah, well, and it's it's conditioning, isn't it? You know, if you make money
Yeah.
from assuming that central banks will roll over, then you could have had a fantastic career, 30 years of doing that. And so, yeah.
And look, 30 years is has been a lifetime career in this business for the longest time. 30 years was about how long most people were in it. So, you know, you've got this other problem that, as you say, people have spent their entire careers learning that this is the way the world works, and it does until it doesn't. And when it doesn't, it's a very, very different world indeed.
Now, one of the things we sort of been pushing, I guess, from our end is that we sort of feel that what a lot of the last couple of years has sort of shown is that we had a decade where we kept on lowering interest rates, but ran into problems about trying to get demand up and pushing debt and, you know, all that type of stuff. So we sort of learned that, well, monetary policy on the way down actually wasn't that effective. On the way up, you know, we're about to see whether it's effective. We think it probably will be. But the other thing we sort of relearned, I guess, was that, you know, fiscal policy really can make a big difference. You throw a lot of money at people, and lo and behold, you get inflation. And I guess the thing we're sort of looking at is going, you know, embedded inflation from here seems to be this argument about will inflation be structurally higher or lower seems to be a lot to me about government reaction. Will you see, you know, a recession and then all of a sudden governments go, oh, let's go and throw money at the population again, because actually we learned that worked really well about getting us out of the pandemic? Or do they go, no, we need to be a bit more austere and think about things in the longer term, and, you know, the whole, and you run down I guess the European crisis version post the financial crisis. You know, I guess your thoughts on, I mean, obviously it's pure speculation about what governments are doing, but you know, I guess from people you're speaking to, and which side of the fence do you think the governments will be more willing to throw money very quickly? Or
Well, look, like investors, governments have also learned from experience, right? So yeah, I mean, their reaction is going to be to try the same thing again, because it's always worked this far. What they haven't had on the other side of this, keeping them honest and holding their feet to the fire, is inflation. There hasn't been a, well, if we do this, we've got to watch out for that. That's not ever been there before. So I don't know that many of them were going to be conscious of that. I don't think the understanding of economics and finance is that high amongst politicians. So I'm pretty sure that their response is going to be, hey, do something to central banks first of all. I suspect the central banks will be more likely to say, no, mate, this is not monetary time, this is fiscal time. You do something. And they will. You know, I interviewed Paul Tucker, the former deputy governor of the Bank of England, a few weeks ago, and you know, he was very forthright in basically saying that what happened after 2008 was that the banks jumped in with an awful lot of monetary solutions to the problems that the world was facing that worked. And then it became time for the fiscal to take over, and the politicians either didn't have the mandate to do it or the will to do it. So they kind of just thought, well, if we don't do it, the central bankers will have to step in and they'll do it for us. And of course they did. And so that reinforced again this idea amongst policymakers that, hey, you know, we can just leave it to the central banks. And Paul's criticism was very much that the fiscal side should have come in much sooner and left us with positive interest rates, and it should have all been done on the fiscal side, but it wasn't. So this time around, I think the central banks are going to take their inflation fighting mandate very seriously, because realistically speaking, all their credibility is tied up in that. They haven't had to worry about inflation for some considerable time. But essentially, the twin mandates are the same for central banks all around the world: stable prices, right, low unemployment. So, because they haven't had to worry about inflation getting out of control, they've been able to be a little more lax with the money spigots. They don't have that luxury anymore. And when you are judged on those two things, and we have this rather persistent inflation, I think they're going to be a lot more strident about looking at policymakers on the fiscal side and saying, "No, sorry, mate, your turn. You need to do something here."
Well, and that's where we did a whole podcast on this just recently. Just on the problem in the Australian market is exactly that thing where you've got the central bank saying we're going to raise rates to get on top of inflation. You've got our two biggest worries in Australia: high energy prices and and high and a rental crisis where rents are soaring, and in response, the federal government's basically allowing energy gas companies to charge whatever they want, despite sort of saying they're putting caps on. And secondly, they've opened borders and said we're going to run the largest immigration ever. And so,
well, look, for Aussie, Aussies is somewhat of a unique case. The problems that Australia has and the potential solutions they have are very different to those in the US. They're very different to those in Europe. The European response was what it was back in 11-12, because they had so many different actors, all with different problems, trying to come up with a common solution to the problem. And ultimately, the weakest links dictated what the policy response was. It was a case of, well, we can't do this because if we do, Spain, Portugal, Italy, Greece are done. So we have to keep them as part of the euro. So the policies have to fix them before worrying about the damage it might do to the Germanys, the Hollands, the Austrias of the world. Outside Europe, it's very different. Every central bank is really trying to steer its own path for its own country. And Australia, obviously, you have this crazy housing bubble in Australia, the like of which the only things that are remotely comparable are across the ditch in New Zealand and Canada. You have this impossible situation whereby if you do have a recession and if unemployment rises in Australia, the housing market is going to come under some severe pressure.
Yep.
I was down in Aussie seeing my daughter in March and was listening to a piece on, I think it was on the ABC or somewhere on the radio, and I was talking about there being 800,000 mortgages resetting this year, mainly in this quarter we're in now and the next quarter, and the vast majority of them are going to encompass 10 interest rate hikes. Yep. That's a massive problem. So Australia's difficulties are a unique set of problems to their banking. The Australian banking sector is wildly different to just about every other major banking system in the world, the way it's structured.
We have it trading at the 98th percentile or something like that in terms of valuations relative to the rest of the world.
And also, but you've got this amazing flywheel of the super, and the money has to go into the banks. And so that there's this, I mean, Australia is actually structured brilliantly in many ways until it doesn't work. And when it doesn't work, it's tough to see any of the cars left in the house not all falling down. So I think Australia's got to be very, very careful. These next sort of 6 to 12 months are going to be really, really important for Australia to try and navigate. I think that's why Phil Lowe is desperately trying to kind of get his hands around the situation again and choke this inflationary problem off.
Yeah, well, and the banking side, our take on that is that, that from a global perspective, in a way, especially with all the support that's been given by central banks to banks in terms of lower interest rates and all these things like that, is in a way you can sort of argue these have become utilities where they can earn what the governments and central banks will allow them to earn, and arguably the Australian banks are closer to the regulators and closer to their supporters than others, and so that's why they earn such great returns relative to banks elsewhere in the world. So
I think that's right. But what size of what's the percentage of their assets that are mortgages? It's an extraordinarily high amount,
especially relative to the rest of the world. Way more
exactly
elsewhere.
Exactly. So the whole Australia's all wrapped up in the housing bubble, frankly, at this point, I think.
Well, and the second part though as well is then we've got I talked about being a turbocharged economy because the rest of it's is the mining side, and obviously if the world economy goes into recession, then mining's tends to fall a lot more in those scenarios than other industries. So yes.
Well, you might. I mean, the one thing I'd say about that for Australia is this move towards de-dollarization that we're seeing, and again, that's another huge debate that everybody's picked a side and everybody's dug a trench and they're all standing and they're throwing brickbats across the no man's land at each other.
I can do a quick definition as well, just for listeners.
Well, this idea that there are a lot of countries that are trying to find ways of doing business without using the dollars, and the primary place for that battle before is in the commodity market, where most commodities are priced in dollars, particularly oil. the Saudi Arabias of the world, the Chinas of the world, the Turkeys, the Irans, all the oil producers, the Russias obviously, are all looking for ways to not be beholden to King Dollar in order to do their business. Right now we have this crazy situation where if the Chinese want to buy oil from the Saudis, they have to do it in dollars and do all the resulting currency trades to make that happen. The beauty for commodities is I think you're going to find a lot of countries willing to stockpile commodities, because obviously if the de-dollarization move ties up with a de-globalization move, which we're also seeing, friendshoring and re-onshoring and all these moves, because the world's getting much more fractious and so it pays to secure your own supply lines, there is a chance that people will look to secure commodities. Rather than hold their reserves in US dollars, they'll want to hold it in copper and iron ore and things that they can use to avoid being beholden to other countries. So there is a chance that bails Aussie out a little bit on that side. I don't think it will be enough to avert a real housing crisis there, but you certainly got tailwinds towards the positive side, just as you have headwinds towards the negative side of Australia.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Yeah, well, and that for me, that sort of comes back to, in terms of China, the Chinese, we sort of run some models where we go, let's have a look at the world commodity use, but let's actually separate out the Chinese housing boom as a separate entity from the rest of the world and look at that. And because that uses some commodities, in particular, iron ore is a big one, but copper to a certain extent as well.
Copper, yeah.
And if you go, well, okay, well, if we separate that out and you look at the rest of the world, you're like, okay, the growth's hasn't been particularly big. It's actually all been this massive China boom. Now starts are down 50%. The actual the amount building in China hasn't really fallen that much. It's sort of fallen more like 5 or 10%. But that's the part where we're sort of going, well, that's our key. If we get that right or wrong, it seems to be that China's going to let the housing boom the housing construction boom sort of fade away now and not sort of rebail it out again. I guess any thoughts from you on terms of that whole China housing boom and whether housing construction boom, I suppose, is.
Yeah, I think you're right. I think that they're trying to take the steam or the air out of that as best they can. But that doesn't mean on a national strategic level, they don't still want to stockpile iron ore and stockpile copper. Whether they use it, the beauty of these things, it's not like they got a sell-by date. You stick them in the fridge.
Yeah.
And no matter what happens, the Chinese are going to need copper. They're going to need iron. All these things that they buy from Australia, they're going to need them in the future. And so it's just a case of, do we want to hold our reserves in treasury bonds? And you can clearly see the answer to that is no, as they've been steadily divesting themselves of treasury for some time now. Would we rather hold them in commodities? Because regardless of whether we transact them in dollars or not, the world for the moment does transact them in dollars, and they're not perishable, and we will use them. So it's really more a case of kind of reformatting the way they hold their reserves. Treasury bonds are nowhere near as attractive as they used to be, and of course, a lot of the demand for treasury bonds came from the petrodollar agreement, where the Saudis agreed to, only sell their oil in dollars in return for US protection and arms sales back in the early 70s. That, of course, led to people being forced to hold dollar reserves to pay for energy imports, and they don't hold them as dollars in the bank account. They hold them as treasury bonds. But you can see, Russia's sold all its treasury bonds. The Saudis have been divesting themselves of theirs. The Chinese divesting themselves of theirs. So you have three big holders of treasuries who are all actively reversing course. And of course, that means that the US, with the highest deficits in history, has to find new buyers for that debt that they need to raise to to fund themselves. And at the moment, it's looking like the Fed are going to be the guys who are left on the hook with that. We'll see. But it just amplifies this point that the world is changing, and the world that we've all grown up in, the world, the post Bretton Woods 1945 cooperative, steadily globalizing world, is gone. Now, I'm sure we'll get back to it at some point, but which is cyclical and which is deglobalization, and as I said, reshoring and friendshoring and changing supply lines, and that's a very big thing for all of us to try and come to terms with.
Yeah. Okay. There's a couple of questions I wanted to ask on this one, because this is, I get the whole friendshoring and extending your supply lines and all that type of stuff, and I think there was certainly the big impetus for that in the initial stages. I guess the question for me going forward from here is, it's a little bit like the central banks is saying, well, if I'm a manufacturer of whatever widgets, and I've got a bunch of other manufacturers of widgets, and they've all said, actually, you know what, we're going to have to increase our prices by 20% because we really have to secure our supply line. And I say, you know what, we've had one pandemic in 20 years. Maybe I'll go the other way. Maybe I'll just roll the dice and I'll sell 20% cheaper than everyone else. And I'll just run the old business model, and I'll try and pick up market share. And you know what, if I have a pandemic, well, I'm in trouble. But if we don't, I'm the winner of this. And that whole, I don't know, prisoner's dilemma, so to speak, of companies, if you're one of the other ones trying to secure your supply chain, and you see somebody else taking all your market share, and so I'm just, that's the part I sort of feel we're going to start getting into at some stage, and I'd be interested in your thoughts on that.
Well, look, it's a valid point. However, the trouble, I think, comes from the fact that this becomes more geopolitical and geostrategic in nature, and it's not necessarily free market capitalism like we're supposed to have seen for the last 40 years, where companies can go and do what they want. It's going to be much more governments putting pressure on companies. Right, we want you to bring back some of that manufacturing. We want it onshore. We don't want you. We want to lessen ties and reliance upon China. We want to lessen our reliance upon these countries that we deem bad actors.
The Inflation Reduction Act type stuff.
Yeah, well, that shows you, right? If you look at that, if you look at the Inflation Reduction Act, look at the CHIPS Act, you can see what's happening here. This is a very deliberate geopolitical strategic decision that we are going to tell you what to do, and here's what it is. It's going to be more here and less there. So I don't know that companies are going to be in a position, certainly not, US, China, the countries that are all now, the other countries that are caught in the middle.
Oh,
right. But
sorry, but I guess where I'm getting to is that, yeah, sure. But I guess where I'm getting to with this is, effectively, that's the CHIPS Act to me is an admission that actually we can't rely on companies to get stuff out of China themselves. We've actually got to financially incentivize them. We need sticks and carrots in order to do this.
Absolutely right. But it's changing the entire landscape of the production function of just about everything that has a chip in it, which is just about everything these days.
Yeah, absolutely. Well, and that's probably, I know we're jumping around a bit everywhere, but but we did talk about it briefly before, the whole artificial investing boom. I'll tell you where we start from my perspective. I sort of look and go, okay, how much got spent last year on AI, and they look about $100 billion, say, and how much got spent on capex in data centers, and maybe 200 billion. And I look at those and go, okay, well, what happens if we're into this boom? Can they increase 2 times, 3 times, or whatever in a short order? Yeah, sure. It just doesn't seem big enough, though. Like, an extra, if we're spending $100 billion last year on AI, and we go, let's say we spend, I don't know, 400 billion in the next few years, and most of that goes on salaries anyway. It doesn't seem to be large enough to sort of save the market, I suppose, in terms of where, I don't know. So,
well, I think there's two sides to the AI thing, right? How is AI going to change our world? How is it going to change the way we do what we do? How is it going to change the employment market? How is it going to change our own workflows and processes? That's the one side of it. Then there's the other side, which most people seem to care about, is how can I make money out of this? Right? It's like, oh, I want to invest in AI. What they mean is, I want to.
The first side's a productivity argument. Is that what you're saying? Is it like that everyone's getting a little bit more productive, like the internet or PCs, and so the first.
No, I think we're getting bombarded with AI. You can't open a newspaper. click on an internet news site without seeing an AI story.
Mm.
So those of us who don't work directly in the AI field have this kind of idea of what AI is, and that is largely shaped by all the articles that we're bombarded with about AI. So if you were to poll 5 people down in Collins Street in Melbourne and say, right, okay, ask them a lot of questions about AI, you could be pretty sure that all the answers would be the same. Oh, they're coming for our jobs and they're going to replace a lot of workers, and they will come out with the same 5 or 6 AI related ideas that we're being bombarded with, which is totally fine, right? We all understand that. Speak to 5 guys who work deep in the bowels of AI. They're looking at it in a completely different fashion about what AI is, what it can do, how it's likely to change the world. So what we do as investors, and that's both as professional investors and retail investors, is we think, all right, AI is the next big thing, just like crypto was, like the metaverse was. This is why Nvidia's done what it's done, because people have gone, oh, I can cash in on the AI boom by buying Nvidia, because that's the one everyone's talking about. I'm going to buy Nvidia. And that's why it's trading at whatever number, 150 times revenues, or whatever the crazy number it's trading on, which anyone in the investment industry is going to look at and go, you can't buy that there. It's ridiculous.
It's Cisco. I like that whole argument. That
it's Cisco. It's the Scott McNealy Sun Microsystems quote, right? And if anyone listening to this hasn't read that, then I'd urge you to Google Sun Microsystems, Scott McNealy. What were you thinking? Because after the dot-com bubble burst, he basically talked about how his company was trading on 10 times sales. And he went to the analysts and explained what that meant in real terms. If you're going to buy my company at 10 times sales, here's what I'd have to do to make you money. And when you read that, you realize just how ludicrous the whole thing is. But of course, we're back there again, and it's magnified. Well, so this AI thing, go ahead.
I was just going to say, I love this. I always show the Cisco earnings chart, and I say, people said about how Cisco is great and all that type of stuff, and they were right. It earned 30 something cents in 2000, and now it's earning like $4. It's like gone up more than 10 times. But you still would have lost money on the shares, despite the earnings going up 10 times.
Exactly. So that when the narrative gets ahead of the company, which is exactly where we are in AI, you'll make money in the short term while the frenzy is still going, and then the frenzy will die down, and market valuations will reassert themselves, and most people will lose money. That's just the way it is. Meanwhile, the people who really are interested in AI and really understand it are looking around for these little companies doing crazy cool things over here that aren't Nvidia, and you can make some real money out of AI if you find the right companies that no one's really looking at yet, because they don't understand that they're second, third derivative beneficiaries of the AI boom. So the picks and shovels, if you like, if you want to go back to the old prospectors analogy. So AI is it's here. It's a fact. It's going to change our world. We don't really know how yet, but at the moment, everyone wants to make a quick buck out of it, and the easiest way to do that is to buy Nvidia for the time being.
Yeah, that's right. And for me, it's that part about going, look, I do think there's a productivity boom coming, but we're talking about 0.5% a year or an extra 1% a year or something over a course of 10, 15 years, and that's fantastic for the world economy and great. But you don't get that. That doesn't bail out a current overvalued stock market, in the next 6 months.
No, it doesn't.
Right. So, and in terms of valuations, so let's say we do hit a recession, and markets tumble. At what point, or even just markets tumble, I suppose, without any need to hit a recession? At what point do you start saying, actually, these levels look all right? So let's use 12-month forward PEs, I guess, as a proxy for.
Well, look, for me, I look at the range of times over the last 40 odd years where you've had bottoms. You go back to 1982 when the Dow bottomed, and you could buy good quality stocks with 6% dividend yields on 6 times earnings. And when you reached that point, you could buy those stocks. You could put all your money in those stocks and never look at your portfolio again. If you buy stocks, good quality stocks on those kind of multiples with those kinds of yields, you're not going to lose money over the long term unless you're trying to day trade them, which why the hell would you do that? So that's what a real bottom looks like. That's what a washed out bottom, when everyone's sick of the stock market, no one wants to talk about equities, And there's a non-zero chance we get there again. We reach that point. If we have the kind of crash that this market is potentially set up for, you could end up there. I doubt it. I don't think we'll get that low because there's just too much money sloshing around. Back in 82, there just wasn't as much money being pointed towards the stock market as there is today. So I don't think we'll get there again. But could we get back down to single-figure PEs? Absolutely, we could. But you'd have to start thinking that, 10, 11, 12 PE, given where the market has traded for the last, 30 years odd, would be a place where you could start to find some value. But again, it's such an important thing for people to understand. Value is so subjective. One person's value is another person's overprice. And so I say this to people all the time whenever I'm giving talks or talking to kind of wealth managers or high net worth individuals. Is like, you have to first of all understand your time horizon. You have to understand, are you trading to make a profit in the next 2 or 3 months, or are you trying to buy assets that you can buy and hold? Because without knowing that, value is completely different. If you're in the first camp and you're looking to trade something for the next 2 or 3 months, you could make a very good case why buying something on a 25 PE is a really good deal because it's likely to go back to 30.
Yeah, and as I said, I might not like Nvidia, but I certainly wouldn't be shorting it because
exactly right. Yeah, exactly right. So, everybody's looking for commoditized ideas and what's the right thing to do, and it just doesn't exist. It's what's the right thing to do for me, and that is the first question in a much, much longer conversation. But if you don't have, you leave yourself open to a very, very high chance that you'll end up being disappointed.
Excellent. That's a very good summary of the of what Sam spends most of his life talking to customers about.
I'm sure. Yeah, you guys have this you live this every day. I'm sure you have guys coming into you saying, "Hey, so where do we put our money?" And I bet the next thing you do is ask them a whole bunch of questions rather than saying, "Oh, put it in high caps or value or growth," because where do I put my money depends on 50 things that you need to understand about them.
Yeah, that's right. It always comes back to what are you trying to achieve and what are your time horizons, and we start the conversation there, and like you say, you've got to find out what's actually right for you, for the individual and what they're trying to achieve.
Yeah, so true.
Now, we've got a limited amount of time, so I might try to sneak in one sort of more topic, which is the idea about the whole green energy sort of transition. I guess the effect on two things. One is sort of energy costs within Europe, in particular, but filtering out to other countries, I think. But Europe's probably the epicenter of the electricity side, and then oil, the where that sits in sort of how you think about the transition and speed and investability, I guess, of different assets there.
Yeah, look, I mean, I think the green energy debate is, I find it perplexing, to be honest with you, because what's happened is it's become an ideology, and along with the green energy thing come judgments about your character. Along with investing in fossil fuels come judgments about your character, which is ridiculous. The plain truth is, this idea that we can be zero emissions by 2030 is an utter nonsense. It's a political construct. They pulled a number out their asses like they tend to do and say, we will be neutral by 2030. And then they go away from the podium at the meeting where they made this, and they say to a whole lot of people in suits, right, you heard what I said, now let's make it happen. You can't. And if anybody thinks we can wean ourselves off fossil fuels in the foreseeable future, they're just wrong. That doesn't mean it's not a great idea, and it doesn't mean it's not a noble aim, and it's something we should all be striving towards to make fewer emissions. Absolutely, I agree with that. But mandating that you will do it by here without providing the solutions as to how is utterly ridiculous. And unfortunately, we are the world over led by ridiculous people these days. There isn't a leader anywhere to be found, certainly not in the West. And so you get these pronouncements made, you get these promises made that people then defend. And once again, we have the same problem we talked about at the top of this conversation. They make these promises very publicly, and so they're held to them, and it's very difficult to come out and backtrack on them. So the policies get more and more ridiculous like we're seeing with energy policy in the US, which is, I mean, for the most powerful nation on earth, I mean, it's imbecilic. But it doesn't mean that we shouldn't want to be carbon neutral. The question is, how do we do it the right way as quickly as possible, but without creating the market disruptions and the crazy pricing structures and the pain that we see based on political decision making. It's such a ludicrous situation where politics has stepped in to do what they think is good and do it in arguably the worst possible way. You couldn't invent some of the policies these guys make up. You really couldn't. If you were trying to be as foolish as you could, you'd come up with some of these energy policies. But there's a reality to it. And as much as we all want a green future, and we'd all love to have zero emissions, let's work out what we can do and then strive to incrementally do better rather than doing what they're doing. It drives me crazy, to be honest with
you. Yeah. Well, you know, the Australians are very used to this. We had a carbon, we had a carbon pricing mechanism, and then we've thrown that away, and now we're into 23 different versions of whatever it can that don't sound quite like the thing we threw away, but sounds, you know,
it's just politics. It's just politics, and it's a real shame that we have to be led by politicians.
Yeah, and so that's right.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Do you look upon then as opportunities within this sector? I guess, is this the idea that you know, we won't have enough oil production because people are worried about what a politician's going to do, and so the net effect will be shortages, and we'll go through periods like that?
Well, that's the next inevitable stage of this. Of course, it creates opportunities, and that's really the other side of the problem, is that those opportunities are being created, and because of the policies that create the opportunities, they forbid people from taking advantage of those opportunities. You know, you cannot invest in fossil fuels. You know, we are going to mandate that we will divest ourselves of all our fossil fuel investments. Why? Yeah. Why? The world needs oil. I don't make the rules, and I don't, like I said, I'm not part of big oil. I'm not being funded by, you know, the evil oil lobby, but I'm a pragmatist, and I realize that we cannot just stop using oil. Yeah. We can try and lessen our dependence on it, but mandating that, hey, you can't invest in this amplifies the problem, because it takes capex away, and we end up in the place we've been the last year because of the Russia-Ukraine conflict, where all that energy policy has led to the crazy energy prices we've seen. So, you know, we are, as my friend and mentor Steve Deagle says, we are clever little apes, and we find solutions to things. That's the whole history of mankind, and we will find a solution to this. You know, you only have to look at the fact there was zero green energy 50, 60 years ago, and look how far we've come. But the practicality is it might take another 50 or 60 years. But if it does, that's not because people are sitting back going, you know, I'm not going to bother trying to get me green energy because I'm just going to use it. No, these guys are all working towards that. So let them work. Let's see how far we can. Divert government money towards green initiatives by all means, but stop mandating. You can't use, we're going to outlaw gas stoves by, you know, natural gas stoves, and make you install heat pumps. But it's ludicrous. The whole thing is ludicrous.
Excellent. Any other big topics, I guess, that sort of sit in your mind that was missed? Any sort of big, the two?
Well, I think we touched on this de-dollarization topic, and I think that to me, between that and Japan, I think those are the two things that I'm most interested in right now.
Sorry, Japan. What was the...
Yeah, Japan. I'll come to Japan in a second, but this de-dollarization idea is, again, as I say, there's a trench been dug. There's people on both sides of it. The dollar's never going to go away and lose its supremacy, and the dollar's going to die tomorrow. They're basically the two extreme cases. And there are people absolutely entrenched at those positions. For me, it's a little bit more nuanced. You've got the dollar as a reserve currency, and you've got the dollar as a reserve asset, and they're two very, very different things. You know, in trade terms, the dollar is not going away anytime soon as the global reserve currency. It will be the grease that oils the wheels of commerce for the foreseeable future. But this idea of it being the world's reserve asset, as we touched on earlier on, people would recycle their dollars into treasuries. That is clearly being challenged. There are countries looking to divest themselves of treasury bonds. We saw the biggest purchases of gold by central banks going back 50, 60, 70 years in the last couple of quarters. So clearly, ever since the US Treasury sanctioned Russia's and froze Russia's foreign reserves in dollars, every other central bank in the world now needs a plan B. They don't know whether they're going to be on the right side or the wrong side of the US in some particular issue somewhere down the track. And you can see this happening. So there is a move underway for countries to find ways of not having to hold as many dollars. They'll still have to use them. They'll still finance a lot of their activities with dollar-denominated debt, et cetera, but they're not going to want to hold those dollars as long-term assets. So that's one story that I think everybody needs to be paying attention to, because it matters. It matters a great deal. And the other story I'm interested in is Japan. You know, I've written about this recently. I started my career in Japan back in the mid-'80s, and you know, back then Japan was the big story. It was the second biggest market in the world. Everybody in America was worried that the Japanese were going to overtake them as the #1 economy in the world. At the time, Japan's GDP was something like $5 trillion, and the US was $7 trillion. They were that close to the US. Obviously, since then, the US's GDP has soared, and Japan's has remained largely stagnant. It's higher, but it's not materially higher. The gap between the two has increased significantly. But with the Bank of Japan finally starting to have a little bit of success creating inflation, with the Bank of Japan finally starting to look like they may be forced out of yield curve control and rates may have to go up, what's happened in the meantime is Japanese companies, which were some of the best in the world 20, 30, 40 years ago, and are still some of the best in the world, have gotten their balance sheets in shape. They've gotten their corporate governance in much better shape, and their valuations have come down to the point where you suddenly have the third biggest economy in the world, world-leading companies in just about every sector you can imagine, trading on multiples that make the US, for example, look ridiculously overvalued. And Japan's a real country. It's a real economy. They're real companies. And like I said, those companies are in tremendous financial shape. So I personally think Japan is going to be a place where an awful lot of focus is going to shift. And I think there's finally some really good money to be made investing in Japan again.
Oh, look, I hope you're right. We're well exposed to Japan. It's I think a lot of the transition stuff, as you said, you know, whether it's robotics or AI,
Yep.
or you know, there's some good healthcare stocks there. You know, it's the whole range of stocks you can pick up, and yeah, it's just a question of when we get rewarded for those holdings. So it's been reasonable over the last few years, but yeah, as you said, they're still trading.
But you may not have been rewarded for them, although the topics is at a 30-year high now, I think. So the rewards have come, but again, we come back to this idea of the companies you've bought. You own those companies at tremendous multiples, right? They're not crazily expensive. They're not at levels that leave a massive amount of room for compression. You know, you own them at good levels, and that's if you're a long-term investor. Yeah, exactly right.
Yeah. Excellent. So we might well, look, thanks a lot for your time. We really appreciate having you on. And Sam, you got anything you wanted to wrap up?
Yeah, Grant, so we'd just like to give you an opportunity just to let the viewers know, you know, where they can find out more about your work and anything that you want to, you know, let them know about. So
very
stage is yours.
Simple. That's very kind of you, but anything you want to know about me, you can find at grant-williams.com. And my Twitter account is at ttmygh. That's it. Very, very simple.
Fantastic. Well, thank you so much for coming on the show. Absolute pleasure to have you. And yeah, we'll wrap it up there.
Pleasure was all mine, gents. Thanks for having me.
Yeah, really appreciate it. So we obviously could have spent another hour or two, well, several hours going into each of those topics, but as you've already done on a lot of your podcasts. But yeah, really appreciate your coming on.
Great pleasure, gents. Thanks for having me.
Thanks a lot.
If you enjoy our content, subscribe to our YouTube channel now, like the video, and click the bell below to make sure you don't miss out on any special episodes and future content. Also, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you please share it with them. We do put out a lot of other content in addition to this podcast. We have regular articles that are featured in all the major Australian publications. To get this, you can subscribe to our weekly Nucleus News and Investment Insights at nucleuswealth.com. We do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, drop it in the comments section below or send us an email to contact@nucleuswealth.com. So for myself, Damien, Grant, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.